we're talking recent deals, things we've seen in the market, and I'd say differences 2025 to 2024. So maybe if you could start by giving us what's actually moving. Are we seeing more refinances? Are notes coming due? Are you seeing some more purchases in the market? What has been the general theme in the last couple of months?
Well, what I would say if we're comparing 2024 to 2025 is there's action in 2025, which is really good.
Love that.
I feel like it picked up towards the end of 2024, like that last quarter. And then we've had some more activity, obviously, because treasuries had been coming down. I think sellers have started getting a little more worn down on getting their price that they had to have. And they're more facing what the market is actually willing to pay. So we've seen more of that. Definitely people are lots of assessing whether or not it makes sense to refi now because their rates are adjusting now in the next couple of months or over the next 12 months or so. So many conversations. I know both of you and I are talking to people where it's like, what would rates be today? Okay, I'm going to hold off for a few more months. Let's keep in touch. Let's see where things go. So that's what I'm seeing, because actually what's kind of interesting happening right now for the people that need to refi is that treasuries have been coming down some. So when their rate adjusts, it's not as much of a shock as it was, say, 12 months ago.
Yeah.
So people can go, okay, well, maybe my rate's like going to adjust. It's going to be 3/4 of a point or half a point higher than where we're at today. So I'm just going to hold off and pay that increased rate and maybe just refi one time.
Yeah. Well, let's talk about that. Would you say in the short term, we've probably seen, if we're going to go down that track, that what are investors most looking for? Is it lowest interest rate? Now the rates come down. Is it a shorter prepay for a short-term strategy? Because I think we have both seen a lot of maybe 3-year fixed or shorter term type of money in anticipation of further rate decreases. So maybe there's a short-term strategy and then a long-term in a few years.
100%. So this is more like a stepping stone to your ultimate loan. So it's like, give me the shortest prepay, which is typically the 3-year fixed. A lot of people want interest only, obviously, because cash flow is being impacted right now, lower rents and higher expenses and all that good stuff. So it's like interest only, shortest, little to no prepay if possible, because I know I'm going to be refinancing in the next few years. So people are definitely looking for that right now. And I know if they're doing anything right now, it's stepping stone to just maybe lock in on something fixed for 7 or 10 years or in the next few years. And then the other thing is, if people need cash out to buy, I mean, we've been doing a lot more lines of credit and things like that creatively, just because they're locked in on that low rate for maybe another year or 2 or 3, and they want to access capital because they want to be ready to buy when the opportunities come. Because we've seen a few more opportunities recently. So having cash at the ready, and also knowing that you're paying a higher interest rate on a smaller loan amount for now until you can refinance in the future is
Right.
way.
I agree. Yeah, I think a lot of those sellers are starting to realize a softening of rents. I think we've even seen some appraisals come in lower than expected, which has kind of readjusted the market, which is interesting timing with rates coming down, because maybe it would have sized with in-place rents, and then the appraisal actually comes in a little softer, and so now there's a shift of expectations. Okay, what can we do today versus what are we going to do with another maybe percent decrease in interest rate?
Yes. I'm also seeing lenders being more focused on global cash flow. And so that's like a big thing that I'm seeing. So for example, what I've seen is like the flippers, for example, that have a ton of properties they're flipping and things right now, like that could be a problem for a lender because they're looking at global cash flow. Or somebody who was even renovating properties over the last few years, and that's what's showing on the tax return. And so they're looking at that global cash flow. So that's another factor. I mean, there's so many things with lenders, right? Like this lender has interest only, but that lender doesn't. This lender has a lower rate, but then they have a higher prepay. And now it's like, okay, this lender really looks heavily at global cash flow and this one doesn't. So like we've been telling people, there's just not like a one size fits all, and you're not going to get everything you want in one loan. So you really have to weigh out what's most important to you.
For sure. Yeah. And I think, like you said, on some of our initial conversations with clients, whether looking to purchase a new acquisition, 1031, or they're starting to refinance, I think we've seen the initial question is, what does 5 or 7-year money look like? And then there's almost a realization of like, I want 3-year fix because we're not in 2020, 2021, zero interest rate policy, like crazy low interest rates. But the anticipation of where they could be in a year or two is probably 5, 7, or 10-year money at that point, like not missing that opportunity again.
Yes. I mean, now is the time more than ever to get like the shortest term fixed. If we had a competitive adjustable, I would be selling that all day long.
Yeah.
But the best thing we have right now is that 3-year fixed. A lot of us, myself included, locked in at the 3% interest rate fixed for 5 years when I probably should have locked in at 3.5% rate fixed for 10 years. So it's like now we know strategically in a higher interest rate environment that we're probably looking for a shorter term fixed. So that way, once rates do go down, that we'll lock it in, like set it and forget it for a little while.
Right.
If this is a long-term hold.
So outside of rate, what should investors or potential investors be thinking about if we're entering a declining interest rate environment for the first time instead of an increasing rate environment? Is there something specific outside of rates that they should be thinking about?
I think the next biggest thing is really prepay, right? I mean, it's prepayment penalty. You want little to no prepay, or we have certain lenders that will allow you to refinance with them and they'll waive the prepay, or will allow you to sell the property. There's a couple interesting lenders out there where you don't pay the prepay. So if you can't get away with having no prepay, you want to look at the lowest prepay or lenders who are more flexible on their prepayment requirements. So that's, I think, the most important thing to look at. And then again, is there a possibility where you just get a line of credit instead so you can keep that low rate and then only pay out the money whenever you beat it?
Yeah, I think we've been way more creative the past 6-8 months than what was even cookie cutter, but just a higher rate. So it was a hard, tough pill to swallow.
Yes.
But there was cookie cutter. Now we're getting creative. So maybe even having certain investors look at what other cross-collateralized property we could look at. How can we use some equity from something that's done well, maybe from the last 5 years to be positioned now that sellers are maybe about to be more prepared to not get the best possible cap rate that's not maybe existing.
Yes. I mean, we recently closed a deal where we did like 6 loans to make 1 purchase happen.
Yep.
So it's like, yes, we look at your whole real estate schedule to say, how can we make this happen in the best way possible? But that is also the beauty of, like, if you have a real estate portfolio and you've already built up equity, you can actually tap into that equity and buy a property for potentially really no money down, like no money that came from your dollars earned at whatever your day job is or whatever. You literally grew your portfolio with your existing portfolio.
So cool. Even just see that the risk tolerance that gets spread out and it goes down when you look at like a combined loan to value not actually being that high, the value of having those assets in place. And what about for someone who's getting into the game, whether they're going from residential, making the leap to commercial, going into this next period? What should they focus on outside of growing net worth, having some cash liquidity ready for down payment?
I think really somebody who's willing to make that next step is just understand how commercial loans work because they're completely different than residential. I mean, people call us all the time trying to buy their first apartment building, and then they send us the numbers and we're like, oh, we can get you like 60% loan to value or 55% loan to value, and they're shocked. Yes. So it's like, first off, you have to understand how properties are underwritten and what that looks like. And we might have other solutions to get you to a higher loan to value, but just understand that you cannot come to me and say, I need a 75% loan to value. And I just go, okay, that's the way it works. And you're going to negative cash flow, $2,000 a month. And our lender's okay with that. That just doesn't happen in our world, which I think is actually a good thing because the person that's looking to buy apartments, I know that is an initial disappointment. It's super disappointing, but actually, what I look at it as is, for one, the bank is making sure that you're making cash flow. Yes. And 2, quite frankly, you're sort of forced to understand cash flow, which you didn't have to before. Like, your residential agent could have sold you a 4-unit property with negative cash flow and you got max loan to value. And it's like, what is the purpose of buying real estate if it's not to increase your cash flow?
Yes.
So I feel like it's like getting an education that you didn't have before stepping over. So I would say talking to somebody like us would be the first step to understand cash flow and how that works and how it affects financing.
100%. I've had a few even scenarios recently of people calling in on what looks like a wonderful property. It looks recently renovated. It's beautiful. Maybe they've had historical tenants in there. And now all of a sudden the conversation goes from a purchase to a possible bridge loan. And now they're thinking about, wait, I have to pay this off in 3 years. How can I even get close to the loan dollars I need to pay off the bridge loan? Just like to your point, forces you to actually think of positive cash flow. The reason I'm purchasing an investment property is to cash flow, is not just to own something for owning's sake.
And like having a business plan, maybe. Yeah, that's good.
Yeah.
So I think if people just don't normally go into real estate thinking it's like a business. And so when you cross over the commercial side, you're really forced to look at it that way because you do have to have these exit strategies. And that's the one thing I think a lot of people too coming from residential get really nervous about is like they're used to the safety of that 30-year fixed. Whereas now they're looking at like a 3 or 5-year fix or even 7 or 10 is scary for people who are used to 30 years, even though they don't keep their loan for that long.